has always been kind to the Institute. He was kind enough to accept our invitation and share his wealth of knowledge with us. He will be enlightening the members on import and export provisions in GST. In the second half of the program, so we've divided the program into two sections. First is from 5 to 6 approximately, and the second section is from 6 to 7 p.m. We'll be doing a very contemporary panel discussion on this topic on audit quality maturity model. The Institute has released the audit quality maturity model on 1st of July, 2021. And to discuss the same, we have two very esteemed practitioners, CA Sanjay Vasudevaji, who has been a Central Council member, and CA Vishal Sharma, who is a partner with SR Bartley Boy. We'll be also joined by CA Durgesh Kabraji, the current Central Council member, and who is the convener of the Center for Audit Quality. But let me first start with the first topic, which is on import and export provisions in GST. As I said, we have CA Ashok Batraji. Although Ashok Batra sir need no introduction. However, the young members as well as the experienced members need to know that what could be the depth of knowledge of one person and what could be the expertise of a person. So it's always inspiring to give an introduction. So introduction is given not for the speaker, let me tell you. It is given to inspire the members who are participating in the program. Ashok Batra sir became a chartered accountant in 1981. Besides, he is a law graduate. He is an alumnus of the prestigious Shri Ram College of Commerce, and myself and Sanjay Vasudevaji also happens to be from the same college. And Ashok Batra sir is presently a senior partner in AK Batra and Associate, a firm which he formed in 1982. Sir has excellent academic credentials and immense exposure in the field of taxation with specialization in DVAT, service tax, and GST. In fact, GST and service tax are synonymous with Ashok Batra sir. He possesses, and in fact, I tell you how many practitioners will be there in India who specializes only and only in GST. Ashok Batra sir is one of those leading practitioners. His experience of more than 38 years in business and taxation consultancy and 15 years experience in the litigation matters. Many cases professionally represented by him have been reported in the leading law journals. His professional dedication and integrity of the highest standard have enabled him to be continuously associated with the leading organization, both in the public and the private sector. He has authored many books. A few of them are the GST Law and Procedure, GST Audit and Annual Return, GST Ready Reckoner. He also wrote a book, Sabka Vishwas Scheme 2019. And of course, there are a number of articles in the leading journals that he has penned down. He has been a speaker in more than 1,200 seminars, and I believe this number would have actually increased much more because webinars might not have been added to it. And he has delivered sessions across a very broad spectrum of the professional institutions, whether it is ICAI, ICSI, Chambers of Commerce, trade associations, National Academy of Custom, indirect taxes and narcotics. We know it as NASIN, nearly throughout India. He's been a faculty of the certificate course on indirect taxes, and of course, he's been a special invitee to the indirect tax committee of the ICAI for many years. We are so thankful to you, sir, for all the contribution that you are making to the profession with so much of humility. He is a soft-spoken personality, and one of the trait that actually touched my heart apart from the many instances. I remember 3 years ago when we were in the Faridabad branch, Dr. Girish Ahuja sir was speaking from the dais, and Ashok Batra sir walked in on the dais. He touched feet of Dr. Girish Ahuja, which all of us do. A person of his standing, stature, having this kind of a humility. Girish Ahuja sir is Bharat Ratna for all of us, let me tell you. But the kind of humility I just want to highlight one personal instance. So I mean, as I said, your contribution is immense to the profession, and it's always a pleasure to hear you. GST is not my specialization, sir. Let me give a disclaimer. But when we see you speaking, we also get knowledge of GST. So, sir, thank you so much for coming. And I would request you to kindly give your deliberation. And at the end of the session, I will take up some of the questions which you may receive from the participants. Thank you, and over to you, sir.
Thanks, Sanjeevji, for the nice introduction. At the outset, I would like to thank Committee of Members in Practice for providing me this opportunity, wherein I can share my views on a very interesting subject. Why I am saying interesting? Because normally chartered accountants were not into indirect taxes, and once service tax came, they started utilizing this service tax practice. Some of them were really successful, some of them were trying. And once the GST came, I have no doubt my professional brothers will certainly excel in this field. And the way they entered into the taxation era after the introduction of tax audit, and we dominated the direct taxing practice, I personally feel time is not far off when this GST will be dominated not by any other profession, but for the chartered accountants only. So coming to the topic of the day, because the time is only 15 minutes and the topic is very huge. Import and export is one area which has got number of significances. For example, if we talk about export from India, certainly it is a import for someone. Kindly appreciate. Once I am exporting something to a country, then it is an export for me, but import for India, import for the other country. Similarly, it is the other way around also. And every government wants export should be the maximum. And we all understand what is the significance of exports. What is the significance of export for a country? So in a way, everybody wants that export should not be, goods and services should be exported and not the taxes. Sorry, I am taking 1 minute because my slide is not working. Just bear with me for a second.
No problem, sir.
Yes, it has started working.
Yes, sir. Yes, sir, it has started.
Yeah. So what are the fundamentals of export? Every government wants their export to be maximum, and therefore there is a convention or a principle which is being followed pan across the world, and that is goods and services to be exported and not the taxes. This topic of import and export has its roots in custom, foreign trade policy, and other arenas like exports incentive, etc. Certain export incentive schemes are there in foreign trade policy. Custom deals with the import of goods. But we have kept the topic import and export in GST. So as we all know, the root comes from the Constitution, any fiscal law that takes its support from the Constitution. And Article 269A clearly provides that any transaction of import into the territory will be treated as interstate trade and commerce, and central government will levy tax and ultimately share with the states. Now we are coming to the definition of export of goods as given in IGST, because these definitions are different in Custom Act. For example, when we talk about export of goods, it clearly says that export of goods means taking goods out of India to a place outside India. So we talk about physical movement of goods from India to a place outside India. But if you look at the custom law, as per the provisions of Custom Act, the payment must come, the payment must be realized in order to complete the export of goods. But that is not the condition as specified in clause 5 of section 2 when it defines the export of goods. The export of services has been defined in a more comprehensive manner, and it has got 4 ingredients. Number 1, supplier of service should be located in India. Recipient should be located outside India. Place of supply should be outside India. This is very, very important, and we will deliberate upon it. because there are certain critical issues in deciding the place of supply. Payment must be received in convertible foreign exchange or Indian rupee wherever it is being permitted by RBI. We all know there were certain notification when the export to our neighboring countries, Nepal and Bhutan, were also qualified in spite of the fact we were not getting payment in convertible foreign exchange. So it is not only the payment must come, the payment must come in convertible foreign exchange as defined in FEMA, and the supplier and recipient of service should not be mere establishment of a distinct persons. And if you go to section 8, it says in case you have an establishment in the non-taxable territory, that shall be treated as a distinct person. So you cannot export it to yourself. So this is the export of goods and services. And we all know that GST law deals with the goods and services both. So the distinction between these two definitions is very clear. So far as export of goods are concerned, it is only taking goods out of India, whereas in the case of export of services, 5 conditions need to be satisfied cumulatively. When it comes to import of service, then import of supplies, then import of goods means anything bringing out from outside India to a place in India. So bringing goods into India from a place outside India is import of goods. But when we talk about import of service, here the conditions get reduced from 5 to 3. The first condition is supplier of service should be located outside India. Recipient of service is located in India, and the place of supply of service should be in India. Again, I am repeating, kindly see, if the place of supply is not in India, then these are not being covered as import of service, and the recipient of these services is not liable to pay tax under RC. Here I would like to give you one example. Everybody wants that export is to be encouraged. I have already stressed upon that point. Now, assuming a person who is in Ludhiana manufacturing woolen garments appoint one agent in USA, that agent procure the services, procure the orders for him, and once the orders have been received, that goods are being supplied from Ludhiana manufacturer to the person located in USA. Now, this gentleman who has procured the order is getting some commission from us. So now in terms of place of supply rules, this person's location is being treated as the place where he resides or from where he provides the services, location of the supplier. So the location of supplier being in USA, it is not an import of service. Kindly appreciate. A manufacturer in Ludhiana exporting garments to USA, for which he has appointed one commission agent or one marketing agent in USA who has procured the order for him. So there are two supply involved. One, he is exporting goods to his counterpart in USA. Second is he has engaged an agent in USA who has procured order for him, to whom he is paying the commission. That commission might have gone in control foreign exchange, doesn't matter. But because in the case of intermediary, the place of supply is the location of supplier. For the sake of repetition, I'm repeating, because the place of supply. So the place of supply is in USA. In normal common sense, a person will feel, I have appointed a person in USA, and once I have appointed him, he is providing service to me, so it should qualify as an import of service. No, it will not qualify as an import of service, simply because the place of supply is not in India. So it is very important to understand what is the place of supply and how the supplier and recipient. Let me tell you, if you structure your transaction in a badly manner, then these tax liability can be very, very huge on you. I'll give you an example. A Mr. Gupta, who is residing in Delhi, married his daughter to USA. Now he has a son-in-law in USA, but he's a very wealthy man. He wants that he should gift a house to his son-in-law. He engaged a contractor in India, asked him, kindly construct a house in USA on Indian architecture, the architecture which he prefers to be there, that house is being constructed in USA, does it subject to GST? Yes, because the provider of the service, the contractor, is residing in India and the recipient, Mr. Gupta, is also in India. So even if the house is constructed outside India, both are located in India. So in terms of Section 13, the place of supply will be governed by Section 12 because provider and recipient are in India and this activity will be taxable. Now, if we restructure this transaction, that son-in-law who is located in USA, he appoint Mr. Gupta, Mr. Contractor, to construct a building for him in USA. Then the recipient of the service is located outside India, supplier is in India, and he constructs the building because the place of supply is outside India. There is no question of any tax. If there is no question, because being export, so once there is no question of tax, now Mr. Gupta give a gift to his son-in-law and that son-in-law make payment to the contractor. So the transaction is not subject to GST. So it is very important to understand that place of supply, if not in India, it is not an import. Similarly, place of supply becomes very, very important when it comes to GST either. Even same principles are there in service tax also. Now, we are coming to Section 7(2) of the IGST Act, which further specifies that goods imported into the territory of India till they cross the custom frontier of India shall be treated as supply of interstate trade or commerce. We all understand in GST, there are two kinds of taxes. One is CGST and SGST, which is being levied on the interstate supply. Another is IGST, which is levied on interstate trade or commerce. And Section 7, subsection 2 clearly provides that import of goods will be treated as interstate trade and commerce. And the custom area, in terms of clause 4 of Section 2, refer to Section 211 of Custom Act, and according to which custom area means the area of a custom station or a warehouse and includes any area in which imported goods or export goods are ordinarily kept before clearance by custom authorities. So these are import definitions, so they will be treated as supplies. They will be treated as interstate supply. Similarly, Section 7, subsection 4, supply of services imported into the territory of India shall also be treated interstate trade or commerce and will be subject to IGST. There are certain confusion because of one of the judgment which says, of course, that was not the issue, but that High Court made a obiter dicta, an observation, that once an interstate supply means the supplier and recipient both are in the same state. So in the case of import of goods, it may be subject to CGST and SGST, but my personal view, and later on there is an authority of advanced ruling also which support my view, and according to my understanding, once a person is located outside India, the transaction is between the Indian counterpart and the foreign counterpart, it will be IGST supply only. Then friends, if we look at subsection 5 of Section 7, it talk about supply of goods and services both, wherein will be called as interstate supply. So it is not only the goods. 7(5) very clearly specifies when the supplier is located in India and the place of supply is outside India. Then in terms of this section, it will be interstate supply only. Article 269, capital A, which we have already dealt with, which clearly provides that the whole power to make rules is with the central government. The central government will collect the taxes and they will be shared between the union and the state in the manner as may be provided. Now we are coming to the charging section, which is very, very important. 5(1) of IGST Act, which clearly says that there shall be levied a tax called interstate supplies not exceeding 40%, as may be notified collected in such manner as may be prescribed. Now, real issue is the proviso attached to this section. it says integrated tax on goods imported into India shall be levied and collected in accordance with the provision of Section 3 of Custom Tariff Act. Kindly appreciate, the proviso says when you are importing the goods in India, all interstate supplies, if I am in one state and the recipient is other state, they are all interstate supplies. When the supplier and recipient located in different states, when supplier and recipient are located in different countries, again this is interstate supply. But this proviso deal with the second situation only, wherein it provides that IGST tax paid on import into India shall be levied and collected not in accordance with the provision of CGST Act, but in accordance with the provision of Section 3 of Custom Tariff Act. And even the valuation part of it is also being determined under the same act, Custom Tariff Act. But the point of tax, when I am liable to pay the custom duty, is being governed by Section 12 of the Custom Act. Now, Custom Act and Custom Tariff Act, we all understand these are two independent ones. Custom Act is 1962 and Custom Tariff Act deals with the rates, etc. That has been enacted on 1975. So now the point of taxation wherein I am liable to pay the tax is being governed by Section 12 of the Custom Act. Why it is so? Why point of taxation of CGST Act has not been made applicable to this? Simply because once the goods are released after filing the bill of entry, and you are liable to pay tax for all the supplies made in a particular month by the 20th of the following month. In this case, if that has happened, it will be very difficult for the government to recover the duties. So they state that when it comes to IGST on import, then that IGST shall be collected at the point of time when the custom duty is payable. That means at the time when the goods are released from the custom and you're filing a bill of entry for home consumption or otherwise. Subsection 7 of Section 3 of Custom Tariff Act is also being amended to provide for that integrated tax shall be levied under IGST Act only. So this subsection provides that integrated tax at such rate not exceeding 40%, which was the same rate as specified in the My Charging Section 5.1, as is leviable under Section 5 of IGST. There is a cross reference to this on the value imported article as determined under subsection 8 or subsection 8A of the Custom Tariff Act. So long as the value and rate is concerned, that is being determined with Custom Tariff Act, IGST rate are being defined in the IGST Act, it is payable as per Section 12 of the Custom Act. That means at the time when the bill of entry is being passed. So it is really important to understand. Then comes a very, very important notification, which I am dealing with, 10/2017, dated 28th of June. We all know GST came into effect from 1st July. This notification provides that any service provided by a person who is located in non-taxable territory to a person located in India, then supplier of service shall be treated as the person who is supplying the service. In an example which I was taking, wherein the Ludhiana garment manufacturer was appointing a commission agent in USA, then certainly that commission agent is a supplier. This is supplier of service, any person located in non-taxable territory. And the recipient is the garment manufacturer located in Ludhiana. But if you look at it, there is a we have mentioned in the red color non-taxable online recipient. So any person located in the taxable territory is the normal rule, but then there has been an exception is being created, and that exception is for non-taxable online recipient. What is non-taxable online recipient? We'll understand that, and then I'll tell you why this exception is being created. So in the case of non-taxable online recipient, the definition is provided in clause 16. It says an individual or any other person who is not registered and receiving these services, including government, local authority, and governmental authority. So it is a very inclusive definition. So 4 kind of persons are being included. One is government, another is local authority, third is governmental authority, and finally an individual or any other person who is not registered with the GST and receiving OIDA services, that means online information database and access services, for other than business purposes. So he is an exception. He is not being treated as a recipient when we are receiving this online information database access and retrieval service. When I'll give you an example, you will be able to understand why it is being done. Before that, let us read section 14 also. It also provides that on supply of this information and database access retrieval service, it is the service provider in non-taxable territory who is liable to pay the tax. Why it is being done? Now I'll give you the logic. Every time it is the recipient who is being considered as importer, but in this case, then exception is there and the supplier is being treated who has to discharge the service tax liability, in spite of the fact that he is providing services from overseas. The issue is very simple. Nowadays, this pandemic is going on and everybody is using Netflix, Amazon, etc. Now, if the recipient is liable to pay the tax for the services provided by the Netflix or Amazon USA, then every recipient need to get himself registered, including the government. So the government doesn't want that kind of administrative inconvenience caused to every individual who is not into the business. One who is into the business is registered with GST, he can discharge the liability and a reverse charge, no doubt about that. But in these cases, when I am receiving those services other than business, that is why they have created an exception and they say it is the supplier who will discharge the service tax liability. In case he doesn't have any presence in India, but his agent is there, then that agent need to provide. And in case it doesn't have an agent also in India, then he need to appoint a person who will discharge the liability. Is these exporter of goods and services, they can either export the goods after charging the IGST and then claim refund of that IGST, or alternatively, they can claim the refund of accumulated credit, which is one of the exception under section 54. Normally, refund of accumulated credit is not permissible under GST. But when it comes to export, an exception is being called out. And in GST, another exception is also there, inverted duty structure. So now, accept that block credit, you are entitled for the benefit of that. And there is one major change in this GST era. Now, even if you are exporting exempted goods or the goods which are not subject to GST, even then you can claim refund of accumulated credit. And in the cases where the services or goods are exempted or they are not taxable under GST law, you need not even file the LUT also. Now, section 16(3) normally give you two options, which I have told you. I'll give you an example to understand this. I am exporting goods worth ₹100. For the sake of simplicity, I take the rate of tax as 10%. If I have paid 10 rupees as IGST, I can claim the refund of ₹10, which will be governed by the Custom Act, and my shipping bill itself will be the refund application, and the refund will automatically come to your account. In the case of goods, not in the case of services, because the custom doesn't deal with the services part. So now I can claim the refund of ₹10, or alternatively, Let us say I take a very simple example. I am a manufacturer where my 70% supplies are input for me. 7 rupees I have paid the credit. Then I can file LUT or bond, and I need not charge any tax. I need not pay anything. And then I can claim refund of this 7 rupees. At the end of the day, you are getting a refund of 7, because once you are charging rupees 10 under IGST, you are claiming credit of rupees 7 and paying 3 rupees to the government. So you are claiming a refund of 100, but before that, you are making payment of rupees 3 to the government. So meaning thereby you are getting a refund of 7 rupees, and in other option, you are also getting a refund of 7 rupees. But there have been certain anomalies. When we deal with the issues, I'll come to those also. So now in this 2021, the government intend to make an amendment, though that amendment has not yet been notified. And they say if this payment of tax option will be available only to the notified supplies, and everybody need to export without charging IGST. Why it is there, you will come to know when we will deal with the issues. Now, friends, we can move to another provision which is important. This provision was introduced by virtue of a rule 96 capital B, and thereafter now the government intend to make amendment in section 16 and intend to insert provision in section 16(3), that is, which deals with the input tax credit provision, which is a statutory section. They say that the registered person making zero-rated supply of goods in case of non-realization of the sale proceed, either within the time period as prescribed in the FEMA or extended period by the RBI, or where the RBI dispense with, in that case this condition will not apply, must be realized. In case it is not being done, he has to repay that amount, and the government can recover that amount by issuing them a show cause notice under section 73 or 74. In simple words, they say you are exporting goods. If you are not realizing the payment, then you need to repay the refund of ITC which you have claimed from the government. Once we are dealing with the definition of export of goods, it was very clearly stated taking a goods from India to a place outside India. There was no condition with regard to receipt of consideration. Similarly, in the case of I-16 section also doesn't put up any condition in order to qualify as an export. Now the question comes whether this kind of rule which is beyond the statutory provision can be introduced. The government realizes perhaps they have done their mistake, and then they intend to rectify that mistake by providing that proposition in the statutory section itself. And let me share it with you, friends, that under the Custom Act, it is already there. As per the provisions of Custom Act, you need to receive the payment in case you want to take export benefit. But this provision was not there because this GST was enacted, taking into consideration the VAT and the excise authorities. Most of the things have been taken from VAT. In VAT, the receipt of consideration was never into picture. So that mistake was happened. Now the government tried to recover that mistake. Initially, they committed that mistake. They tried to bring it that condition through rule when there was no provision backing it. Now they want to introduce that through the statutory provision so that tomorrow this rule is not being struck down by the court. Now, friends, one can say that once I am not liable to pay any tax, then it is exempt supply. Can you equate zero-rated supply with exempt supply? According to my understanding, absolutely not. Exempt supply has been defined in section 2. It includes 3 components. One, which is non-GST supply. Another, which is being exempted supply under the law. And then non-taxable supply. So these are 3 supplies which are included in the definition of exempt supply. And in the case of exempt supply, of course, you are not liable to pay the tax. But when it comes to claim of credit, then you need to reverse the credit. Now we have just in this slide tried to compare the two. In the case of zero rated, though I am not paying any tax, but I am not supposed to reverse the credit which is being used for it. I'll give you an example to understand. This is a very simple example. Let us say my 100 rupee turnover is for taxable supplies, 100 rupees turnover is of export, and 100 rupees turnover is of exempted supply. And my credit is, let us say, 30. So I need to reverse only 1/3 credit, which is applicable to exempt supply. I am talking about common credits, because so far as credits which are attributable to the supplies directly, the law is very clear. You are entitled for the 100% credit which is being used for taxable supply, which includes zero rated supply, though I am not liable to pay any tax, and 100% disallowance with regard to supplies which are attributable to exempt supply, and common credit has to be reversed. So in this case, in the case of zero rated supply, in the case of export, certainly they are not liable to be taxed. You can export them and claim refund of unutilized credit, but at the same time, you are not supposed to reverse. That is why the credit is available to you. Now we will deal some of the issues which are there with regard to export of services. And this one of the provision which I initiated, by discuss with you, giving an example of Ludhiana dealer. So the question is, if this proviso, which is enshrined in section clause B of subsection 8 of section 13, was being challenged in the High Court. So far as Bombay High Court is concerned, there was a dissenting judgment. One judge was in favor, another judgment was not agreeing with that. Once they say that this is an artificial restriction being put up in the law, wherein certain activities can never be exported, and once the activity is there, so this rule which says that location of supply is the place of supply is unconstitutional, and it is being it is being challenged. So this Bombay High Court, there is a dissenting judgment, but at the same time, there is one more judgment of the High Court which is in favor of the revenue. So these were the similar provisions were there in service tax law also. And then at that point of time, there was no challenge to this constitution. Of course, it applies to a couple of services, for example, intermediary services, hiring of vehicle and other things. So they clearly stated, okay, this rule is unconstitutional, but now it appears that the government will have the last laugh, and ultimately it will have to be a legal provision. Then another question comes. One of the conditions in export of services, payment must be received in convertible foreign exchange. My point is, a German company has appointed Mr. Batra as their representative in India to file the tenders to look after and provide certain services, including post-sale services, licensing, the logistic, etc. And Mr. Batra is entitled for 10 rupees as commission. He provides services of rupees 100 to Indian government. So Indian government was liable to give 100 rupees to the foreign counterpart, that means the German company. But rather than giving $100 to the German company, Mr. Batra, who was entitled to the commission of $10, the Indian government gave Mr. Batra INR and sent 90 rupees to the German company. The question came, Mr. Batra has not received the payment in control foreign exchange. He should not get the benefit of export of service. The court said, no, that is not the correct. Saving in foreign exchange is also as good as earning the foreign exchange. So they very clearly stated, rather than giving $100 to German company and then $10 being given to Mr. Batra, once this $90 has been given and Mr. Batra has been paid in INR, so country has saved foreign exchange, which is as good as receipt of payment. Now we'll come to certain rules and issues which are with regard to the export of goods. First rule is 89(4)(c). Here, the government has fixed up a limit what can be the value of export irrespective of the value which I am charging from my client. Let us say there is a product X which is being sold in the local market at 100 rupees. I exported it at rupees 200. So the government says, okay, now in order to claim the refund, the formula is net credit multiplied by export divided by total turnover. They say we will consider this value only as 150, 1.5 times the value of like goods domestically supplied by the same, because I am selling that goods in the local market as 100, I have exported it for 200. I really fail to understand the purpose, because ultimately, if I am exporting at 200 rupees, assuming 10% rate of tax, 20 rupees liability I am paying, credit is, let us assume, because my cost is less, credit is 5 rupees. So 15 rupees I am making payment to the government, and I am getting refund of 5 rupees only. I don't know why this rule is being given, and this rule is so vague. Kindly appreciate 1.5 times the value of like good domestically supplied. Now, number of issues will come. Can you change the valuation principle without amending the section which deals with the valuation, section 15? You are saying you reduce the numerator and denominator remain unchanged. So obviously by reducing this, you are giving me less refund. Once it is a less refund, and assuming I am a EOU, I don't have any other tax liability, that credit cannot be used, so it becomes a cost. My export becomes uncompetitive. Section 54, which talk about refund 54.3, and section 16, which deals with zero rated supply, does not prescribe any such condition. Now the question is, this price which you are saying is very subjective term. That price may be of the day, of the month, of the year. Like-minded goods, maybe I had a slightly better packing for export. So this will give a leverage to the assessing officer and will open the door for corruption, which according to my understanding should not be there. And those who are not having any GST liability, for them it is an additional cost. I do appreciate that once they don't claim the refund and the refund is being reduced, then it will be treated as an expense in income tax, and their taxable income will get reduced, wherein they will have saving in income tax. But that saving will be only to the extent of income tax I am paying. Maybe I am liable to tax at 40%, maybe I am liable to tax 20%, maybe I have business carried losses, maybe I am a unit which is not subject to tax being exempted and all that. There can be n number of issues. But in any case, even if I am assuming I am liable to tax at a higher rate, highest rate 40%, assuming for the sake of simplicity, then 60% is my cost. Then this rule, when it will apply, whether it will apply to refund filed but not yet received, or export already effected but refund application is to be made, because refund is always applied after the exports are being made, or only to the exports which has been made from the day this rule is notified and the payment subsequent to that. So this will be a plethora of litigation unnecessarily. Then comes rule 96B. I have already referred it when I was dealing with section 16, wherein I said the sale proceeds have not been realized. Earlier on, it was provided in rule which can be recovered from the exporter. Now they are proposing to insert a section. Amendment has been done. It is being ratified by the government. But unlike income tax, when the president gives the assent, it becomes an act. Here also it becomes an act. But those provisions are not applicable. They will be applicable only from the date of notification, because of the simple reason corresponding amendments have to be made in the SGST Act and UTGST Act also. Now, friends, looking to the time constraints, I think I need to hurry. I'll just do this 96B issue I have already touched upon, so I am removing all the. Now the question comes, if I am exporting with charging the tax, as I gave you an example, 100 rupees, 10% tax is being charged. I am entitled for 10 rupees and I am eligible to claim all the credits, whether that credit is in relation to input service, or capital goods, or even the cess, I can claim a refund. But once I am exporting the goods without charging IGST, then I am entitled for the refund of only GST paid on input and input services, not capital goods. So this provision is being challenged in the various courts. In the absence of such restriction in the export sections, how can the government bring out such rule wherein they can restrict the credit by excluding the capital goods? Gujarat High Court, in the case of VKC Footwear, has agreed that refund should be admissible for the entire credit, including the GST paid on capital goods. But then, in the case of TVL FCON joint venture, Madras High Court has ruled against it. So one High Court is in favor, another High Court is against us. Now the matter is pending before the court. The problem is an exporter, when he changes the mechanism how he has to export, he's getting a different benefit. And that is why when I was dealing with section 16, I told you that now the government is coming out with a scheme where you cannot export with payment of taxes except in notified categories, though that section has not yet been notified. But the intention is very clear. If this facility is being withdrawn, because the person who is exporting the goods or services with tax is going to get a credit on capital goods also and refund of cess, which is not permissible otherwise. So this is one of the anomaly which the government tried to remove. But according to my humble my understanding, if the government want to give a refund, then the better course is both should be kept at the same place and they should be allowed to take credit of service tax on. So far as cess is concerned, there are certain issues. If the time permit, I'll come to that also. Now there is a provision of provisional refund under section 54 subsection 6, 90% refund in 7 days. But does it really happen? If we look at the practical aspect of it, it is not happening. So friends, the time is very short. Now I'll come to another important aspect of deemed export. Then we'll open for question answer session because time is only 50 minutes. Of course, the topic is very huge. What is deemed export? In the case where I say these supplies are being treated as a deemed export, the goods are not moving outside the country. I am getting the payment in INR or foreign exchange. I'll get the benefit of deemed export and those supplies will not be subject to tax. Why it has happened? It is something like import substitution. The example I have given it to you for deemed net foreign exchange payment, same is the thing here. I am having an advance authorization, I can import the goods without paying the tax. And if I buy the same goods from a local manufacturer and he has to charge me IGST, he has been put into a different situation. So the government have declared this deemed export, and this concept is again different in foreign trade policy. If you look at foreign trade policy, there are 8 kinds of goods which are being treated as deemed export. In GST, it is only 4 kinds which is being treated as deemed export, and they have been notified under section 147, only 4 categories. If you talk about foreign trade policy, there are 8 categories of supplies which are being treated as deemed export. So we are covering only GST. So I'll go hurriedly. What are those 4 deemed exports? I'm not going to the definition and things because the time is not there. One is supply of goods by a registered person against advance authorization. So these are various issues. I'll share this PPT with the institute so that they can share it with all the members or they can put up on your website where you can approach it. So I'm not reading this. Looking to the time constraint, I am running now quite fast. Then supply of capital goods by a registered person against export promotion capital good authorization, that is also being treated as deemed export. Then supply of goods by a registered person to EOU, and we all understand EOU including electronic hardware technological park, software technological park, and biotechnological park also. So they are also being treated. And then supply of goods. These are the 4 supplies only which are being treated as deemed export. And the only advantage is the exporter either need not have to pay the tax, but unlike zero rated supplies, deemed export, you have to pay the tax. It is not like that you can make deemed export under LUT or bond. No, that is not permissible. You have to supply the goods wherein you have to charge the tax, and then refund need to be claimed from the government. The refund can be claimed either by the supplier or by the recipient also. In case the recipient wants to claim the refund, he can do so. Or in case the supplier wants to claim the refund, he can also do so. But once the supplier applies, then he has to furnish an undertaking that the recipient will not claim the refund and he has not claimed the ITC of the same. Time period is 2 years, which is there was otherwise. So these are some differences between deemed export and physical export, which I'll just take in 2 minutes. And thereafter, I don't know, should we discuss other concept or should we open for question answer session? I'll ask Sanjeev Singhal they can guide me. But before that, let me complete this. Scope is, in the case of deemed export, goods does not leave India. In the case of physical export, they need to live in India. They leave to go outside India. They are not being treated as zero rated supply. You cannot export under LUT or bond. You have to first pay the tax and refund is to be claimed. As I told you, refund can be claimed by both the supplier and the recipient. In the case of deemed export, it is the GST officer, and in the case of physical export, the refund is being given by the jurisdictional GST officer. And with payment of tax, when I export the goods with IGST, which they intend to discontinue, and then ultimately we will come to GST office only. But right now, that IGST refund is confirmed, is being given by the custom authorities. My shipping bill is the refund application. When the export left, export manifest is being filed, goods leave outside India, information come to the custom and the refund comes to my. Now, Sanjeev, should we deal further or should we take question answers? I think Sanjeev जी भी available नहीं है, तो चलिए हम इस सब्जेक्ट को आगे डील कर लेते हैं. Anyone who can guide me?
Hello.
हाँ जी.
Yes sir. Sir, actually questions अभी ज़्यादा है नहीं. Sir, अभी I think आपको अगर कोई आपका topic
मेरे तो बहुत अभी तो देखिए ना, मेरे पास 13-14 स्लाइड्स पड़ी हैं. We have some important issues to discuss, so we can do that.
सर बिल्कुल सर, बिल्कुल.
Perfect.
So अभी 550 सर 553 हुए. आप 6 बजे 2-3 मिनट तक जैसे भी करना चाहें सर, आप कंटिन्यू करें.
Okay, thank you.
Right sir, right.
Now we are talking about one notification 40/2017, which is very important notification, and it was being introduced when I am exporting goods. I can buy the goods rather than paying the full rate of tax. I can buy the goods by paying a 0.1% tax on those goods, which will certainly reduce my cash flow. It will not impact my cash flow. So notification exempt tax and the maximum tax which can be levied is 0.05%. But this doesn't come as it is. It comes with lot of conditions. Those goods has to be exported within 90 days as it is. That means you cannot do any value addition on those goods. And other conditions are also there. You have to take goods from the place of the supplier to the port, inland container depot, airport or land custom station, directly to a registered warehouse from where the goods will move to the government. You cannot export that goods with IGST, GSTN number of the registered supplier and the tax invoice number issued by the registered supplier has to be mentioned on the shipping bill. Jurisdictional tax officer need to be intimated on that. And once there is a circular by the department by the name of 108/27/2019, dated 18th July. It is a very important circular. It clearly says, in the case you are taking goods out of India, but recipient is not identified. It is for the purpose of exhibition or for consignment or for export promotion. Then that activity does not constitute supply because there is no consideration, the recipient is not being defined. So in that case, it will not be treated as zero rated supply. It will not be, in order to qualify as a zero rated supply, First of all, it need to is supply. Then now I am referring to Schedule 3, which is again very, very important. If you look at Para 7, it makes certain things very clear, which were not there when the law was initially introduced. But later on, the government realizes that these are some things which may attract litigation in the times to come. So they have put up this Schedule 3, Para 7. This is supply of goods from a place in the non-taxable territory to another place in the non-taxable territory without such goods entering into India. So that means these are being called merchant export in commercial terms. When I am buying goods from Dubai and selling it to Tokyo, or I am buying goods from Canada, selling it in USA, in those cases, goods does not come into India. They don't qualify as an import also. Even if I am having my office in India and that income may be taxable under Income Tax Act, but so far as GST is concerned, because the goods have never come to India and they have moved from one non-taxable territory to another non-taxable territory, it will be not be treated either as a supply of goods or a service. So once it is not a supply, there is no question of any tax on that. Then the second is supply of warehouse goods to any person before clearance for home consumption. Once the goods are imported, I was dealing with that, what is custom area. The goods are being warehoused in a godown, which may belongs to the government or a private party, and I want to re-export those goods. Then if I am re-exporting those goods from those warehouses and I have not filed bill of entry for home consumption, that will also be treated neither as supply of goods nor services, not subject to GST. Similarly, the third issue is with regard to when the goods have left the custom frontier of India and I am selling it to Mr. B in India. At that point of time, when the goods are in transit, and we normally in pre-GST era used to call it high sea sale. So even those transactions is not subject to tax. Once I have sold it to Mr. B, I am A who is importing the goods. Goods have left the custom frontier of Canada, let us say, and before they touch, I have given to Mr. B. Now, ultimately, B, when he will file bill of entry for home consumption or he will re-export, he will pay the custom duty and he will comply with all the provisions of the law. So once I am filing the bill of entry for home consumption, Mr. B, I will pay the IGST, not Mr. A. So this Schedule 3, which deals with the subject, these activities are neither supply of goods or services, they can never be subject to tax. So this is one part which I am dealing with. So this is Para 7 and 8. 7 covers merchant export from one country to another without coming into India. Para 8 covers two issues: when the goods are being imported, before we file the home consumption, they are being re-exported, or high sea sales, they will not attract GST. Now, another interesting issue came. You must have visited certain foreign countries, Singapore, and when you are taking certain goods from Singapore of a specified value and you are taking it to India, you get GST refund on the airport. Similar provisions were there. They tried to introduce into GST in India also. And then initially there was one authority of advance ruling which was against that, but later on the government realizes that that authority is not correct. So they have clarified any goods which the tourist is taking outside India will be treated as an export and he will be entitled for the refund at the airport. Now, these are the statutory provisions and our understanding. Now, what is the government understanding? I'm coming to that. Now, the government has issued 108 circular, which we have dealt with. Another circular is 125, in which they have clarified certain things. They have clarified as an exporter, when you are exporting the goods with the tax IGST, then you can claim the whole credit, input service, input capital goods, also the cess. But in case you are claiming the credit and you are not charging the tax, the export is being made under LUT, in that case, you can use the cess liability only for the payment of cess. And in case I am not dealing in such product which is subject to cess, it becomes a cost to me. That is why the government, I think, should bring out that parity which is there. My change in method for export of goods should not result into different benefit to different exporter. Then it is being clarified in that circular, and rightly so. They say furnishing of LUT is only a procedural compliance. In case it is not being done and there is some delay, the export benefit should not be denied. In every fiscal law, whenever you are entitled for an exemption, there are two kinds of conditions. One is substantive condition. It is applicable to ITC also, which are sine qua non. For example, in the case of export of goods, they must leave India. And in the case of import of services, must satisfy 5 conditions. But in case LUT is not filed, then substantive benefit cannot be denied. Similarly,
so may I request you now that I mean, whenever possible, please conclude.
We'll just
yes, sir. Sure, sir.
I'll take only this circular. That is why I asked you earlier also. Anyway,
yes, sir. Sure.
Now subject has been taken. Let me complete this. So now the other things they have clarified in the case of zero rated supply, the value declared in tax invoice, shipping bill or domestic goods, as I told you, that provision came on 23rd of March. So that issue we have already discussed. This is the stand of the government, which you can certainly read through this circular. I have given the circular number. So rather than myself explaining the circular, it is better. Now another circular is being issued, which is against, according to my understanding, is against the provisions of law. They say you are entitled for the credit of refund only for the invoices which has been reported in 2A, which according to me is not correct. But this is the stand of the department. With this, I would like to conclude my deliberation and hand over the proceeding to Sanjeev ji for further.
So, sir, thank you so much, sir. Your style of imparting knowledge is always, actually, I mean, one never realizes that one has learned the subject, and the pace is also very, very comfortable, sir, for the participant. There's an excellent feedback, sir, and which is always there. Of course, I mean, you are above the feedback now. It's been 38 years that you are serving the profession. Thank you so much, sir, for all your time and giving the gift of knowledge to all of us. Thank you, sir. Thank you very much. Thank you. Friends, with this now, we move on to the second section of our program today, which is on the audit quality maturity model. And I'm joined by CA Durgesh Kabraji, who is a Central Council member from the Western region, CA Sanjay Vasudevaji, and CA Vishal Sharmaji. Let me first talk about Durgesh Bhai. Durgesh Bhai is the pioneer for this audit quality maturity model. He's the convener for Center for Audit Quality. And Center for Audit Quality is only the second center in the world for audit quality after US. So it's really a proud moment. And I happen to be a soldier in the Center for Audit Quality as a member for Center for Audit Quality. And the passion with which he has developed this audit quality maturity model. We had numerous meetings spanning 3 hours, 4 hours, 5 hours, discussing the various facets of the audit quality maturity model. So he and let me also acknowledge that it was Dr. Devashish Mitra, who is our vice president now, who was the convener of this group. And then Srinivas Joshi ji and Durgesh Kabra ji gave the final shape to this audit quality maturity model, which may be among the world's first such model. There are audit quality indicators, but such a comprehensive model I have not seen. Of course, we have the panelists today that they may share some more knowledge. But the passion with which Durgesh Bhai is leading the Center for Audit Quality, doing a program on the new age auditors, that's a wonderful program, and that's been received so well, and it's very contemporary in design. Besides, Durgesh Bhai is my co-chairman in the Sustainability Reporting Standard Board, and we've been able to put the Sustainability Board on the world map. And SRSB is also the world's only second such board. Durgesh Bhai is also a chairman committee on insolvency and bankruptcy code. He's a vice chairman committee for member in industry and business, which has done such a pioneering work in these difficult times, COVID times. The kind of recruitments which have happened and the kind of programs which the CMIIB is doing is great. And he's also a member of the Quality Review Board. Durgesh Bhai is an avid speaker, an expert on law and bankruptcy code. He has addressed hundreds of programs, and he's a regular contributor to the WIRC reference manual. And of course, he's a part of about 25 to 30 committees of the institute, and he's been a member of the board of discipline, bench one as well, and all the committees that you can think of, whether it's the ASB or the double ASB or the commercial law and economic advisory, etc. He is contributing to the maximum, and he is also a part of the working committee on the World Congress of Accountants. So thank you so much, Durgesh Bhai, for doing such a pioneering work and an excellent contribution in the council. I'm your batchmate in the Central Council, and it's really a pleasure working with you. And thanks for taking out time. And before I request you to give your keynote address, because you are the one who have pioneered this concept, let me also introduce two of my very, very esteemed friends and the panelists, C.A. Sanjay Vasudevaji. It's always a pleasure listening to him, meeting him, and I have the opportunity to meet him again and again being in Delhi. Sanjay ji is an esteemed past council member of the ICAI. He's a BA Honors, FCA, DISA, Diploma in Ind AS, and I'm happy to say that I had the opportunity to take sessions in the Ind AS course where he was a participant or a student. So in a way, I can call him my student in the IFRS course. He attended the second batch of the IFRS course, which we have taken in 2010, and the classes used to be conducted at the Park Hotel. He's a senior partner of SCV and Company LLP, which was earlier known as SC Vasudevaji. He's an illustrious son of an illustrious father, Shri SC Vasudevaji. And Sanjay ji has an experience of more than 25 years in the accounting profession. There's hardly any facet of accounting profession which he has not touched upon, whether it's statutory audit, internal audit, Companies Act, FEMA, etc. And he has served clients in a very wide spectrum, including manufacturing, services, banking, and finance. During his term at the council, 2016 to 2019, he was the chairman of the FRRB and the vice chairman of the double ASB, vice chairman of the Ind AS Implementation Committee, and vice chairman of the Digital Accounting and Assurance Board. He is currently a member of the Corporate Law Committee of the PhD Chamber of Commerce and the CII National Committee on Financial Reporting. Again, I had the pleasure of his company in the CII National Committee on Financial Reporting. And he's also a co-opted member of the EAC of ICAI. And he has held a position with IFAC as a member of Data Analytical Working Group, technical advisor on the IAASB of the IFAC, member of the Committee on Auditing Standard and Quality Control of SAFA, and a member of the QRB. And of course, as far as the speaking engagements are concerned, there are far too many. So thank you so much, Sanjay ji. And I'm sure that the participants will be immensely benefited by your presence today. Then I would like to introduce C.A. Vishal Sharma, a fellow member of ICAI, having more than 25 years of experience, he's a hardcore auditor and a methodology champion. His files will be rated as the perfect files in any of the review done by anyone. His experience includes working on US GAAP, IFRS assignment, handling IPO and other capital market engagements, and clients across a very, very wide spectrum, both listed as well as unlisted client. And he's a true ambassador of the profession, sticking to the core principles of audit quality. So I thought that Vishal will be a right panelist in this program. And thank you so much, Vishal, despite your busy schedule, for taking out time to be here. I will be inviting all of you for your opening remarks as well. Let me start with Durgesh Bhai. As I said, who has authored this audit quality maturity model. Durgesh Bhai, I would request you for your keynote address on this audit quality maturity model. What was the purpose, from when it is effective, how it is taking shape, and the possible plans for revision based on the time-to-time feedback, and any other aspect that you would like to share. Thank you, and over to Durgesh Bhai.
Thank you, Sanjeev ji. Thank you. Thanks a lot for making me a part of this wonderful webinar in the committee for members and Practice Committee, which you are leading from the front, and not only leading this committee, but leading also the SRSB from the front, and you have made SRSB known across the world, rather, I would say, not only in India. You made the SRSB known, and it's indeed a pleasure for me to work with you in that as a vice chairman. You never call me as vice chairman. You always call me as co-chairman, but it's your greatness. And I'm also learning a lot in that particular committee from you. And as far as this AQMM is also concerned, you have been a very big contributor into developing and designing this audit quality maturity model. So thanks for inviting me and making me the part of this webinar. Sanjay Vasudevaji, the senior member and guide for all of us, being the past Central Council member of the ICAI, Vishal Sharmaji, and other back office team, all the participants. A very warm welcome to all of you. Friends, as we all know that today the world has become a global village, and brand India has been subsumed into all walks of life and profession. We Indians contribute in every economic activity, and India is well on its way to achieving the double-digit economic growth in this year. India is the 5th largest economy in the world in terms of nominal GDP, and 3rd largest economy in the world in terms of purchasing power parity. India's middle class is getting educated and moving up the value chain. Soon the majority of our population would not be just living hand to mouth, albeit with respect, but have surplus fund to invest also. When one invests one's Jama Punji in a company, for instance, he or she relies heavily upon the auditor's signature. Just like in the olden times, the erstwhile Rajas were relying upon the advice of Rishi Munis. We need to strengthen the reliability of that signature, which we are putting on the documents called the balance sheet or statement of affairs. Friends, we all know that today's stakeholders have grown beyond shareholders, and that is one of the primary reasons why we are hearing so many plaintive noise these days. Communication is important as reporting, just as prevention is better than the cure. The auditor is supposed to provide a reasonable assurance that the financial statement as a whole are free from material misstatement, whether due to fraud or error. Although it is a high level of assurance, it is not absolute assurance for all of us. We know this fact very well. In the Brighton reviews, it has been suggested a redefinition of the audit and its purpose. Making auditing an independent profession, which is not an extension of accounting, extension of concept of auditing to areas beyond financial statement, more engagement of shareholders with audit and auditors, change in the language of opinion from true and fair to present fairly in all material respects, provide greater clarity around the role of audit committee, and embracing the increased use of technology. This is what is being suggested in Brighton Review report. Also in the Kingman Review, which recommends the creation of an audit and reporting and governance authority, and ICAI being the regulator of accounting and auditing profession, has taken a lead in forming the Center for Audit Quality under the leadership of Atul Gupta ji, which will provide the regulatory mechanism for determining the audit quality of the firm. So friends, this is what I just wanted to brief you about how this idea has come in the mind of the ICAI and in the mind of the ICAI president, the then president, who thought of this Center for Audit Quality. And let me tell you, friends, nowhere you will see that what is the audit quality and whether it has been defined so far. But I believe that nowhere it has been defined. Audit quality is a complex subject, and there is no analysis of it that has achieved universal recognition. Audit quality cannot be measured, and judging the audit quality can highly be subjective. Assurance follows a risk-based audit strategy. The overall audit risk is brought to an acceptable level by reducing the detection risk through an increased substantive testing in case of a perceived high risk or high fraud risk or little or no reliance on internal control. Today, in the COVID era, the fraud risk is as high as the fraud triangles certainly present. Auditors and audit committees should be in a dialogue over the matter and help map the risk to an appropriate response also. Would it be audit or investigation or forensic that would help provide reasonable assurance to the users? Could the shareholders ask for a supplementary audit as the CAG came, or a compliance audit or an additional review? All it would take is a special resolution by the members in extraordinary general meeting, requested to be organized through the board. Management also has a big stake in the audit quality and integrity of the financial statement. Management should report the principal risk and uncertainties facing their organizations and disclose when material failure of their internal control has taken place. At macro level, all these can be achieved when there is awareness about audit quality. Key stakeholders are encouraged to explore ways to improve the audit quality, and greater dialogue is facilitated between the key stakeholders and audit quality. Now coming to the audit quality maturity model. Center for Audit Quality has brought out an audit quality maturity model version 1.0, which is better known as AQMM V1.0, which is a capacity building measure initiated by the Institute of Chartered Accountants of India, and the objective of this evaluation matrix is for sole proprietors and audit firms to be able to self-evaluate their current level of audit maturity, identifies areas where competencies are good or lacking, and develop the roadmap for upgrading to a higher level of maturity. The audit quality maturity model version 1 is a cross-functional evaluation model for practicing firms covering engagement teams, firms leadership, IT help desk, human resources team, administration department, legal matters, and the management information system of the firm. It is a unifying force for having all hands on deck to help steer the firm from the brown waters of unplanned audit to the blue waters of being globally recognized for audit quality. In the council meeting, which was held on January 9, 2021, it was decided that both the peer review board and Center for Audit Quality would need to develop the ecosystem and which is acceptable to both, and such collaborative approach would have the advantage of CAQ developing the quality standards and peer review board testing the said standards. Using the above mentioned collaborative approach, the AQMM 1 would be recommendatories for 1 year period, and after 1 year period, the council will again review whether it is further to be extended or it is required to be made mandatory. So it will be all on the council that it is going to be continued for some more time. So every firm gets acquainted with the various audit quality indicators which are there in the audit quality maturity model, and they accordingly evaluate themselves. Firms which are auditing the following kind of entities are going to be covered on a recommendatory basis. These are a listed company, the bank other than the cooperative bank, except multi-state cooperative bank or insurance company. So if a firm is an auditor, whether it is a sole proprietor firm or the partnership firm, and doing the audit of any of these entities, provided they are not the branch auditors, then this AQMM will become applicable to them. And that too also on recommendatory basis. It will be revised time and again. And probably after a year or so, if we make it mandatory, then we may add some more thing, or whatever we feel that this is not relevant, when we get feedback from the users of this AQMM, accordingly it will be changed and designed. As is told by Sanjeev Bhai, who was one of the key person in developing this, along with all the learned people, which included who's and who of the profession from across the country, who have helped in developing this particular AQMM. I'm sure that it will definitely benefit all the Indian chartered accountant firms to build their capacity with the help of this. AQMM status, one thing which is important, I just wanted to convey through this, that AQMM status should, however, not be publicized by all the firms, because you are self-reviewing. It is a self-review mechanism, so it should not be publicized by you or mentioned by sole proprietors or audit firms in any public domain. For examples, professional documents, visiting cards, letterheads, or signboard, etc. It may amount to solicitation in view of the provisions of the Chartered Accountants Act 1949. It should not be even disclosed on your website, because though you have done the self-review, it should not be. It may, however, be made available to anyone on the specific pull basis. Since this has been launched, the AQMM has been launched, you are reviewing your firm by using the self-review mechanism. If some stakeholder asks you, you can definitely give them that this is how we have calculated our level, whether it is level 1, level 2, level 3, level 4. So level 1 is which is the lowest one, and level 4 is the best one. So this is up to 25%, 50%, 75%, and 100%. And accordingly, you have to put yourself by doing the self-evaluation. So I'm sure that the audit quality indicators which have been used into this should raise more questions, bring out competitions between the audit firms, and create market demand for the audit quality by using this AQMM. So with this, I believe that very good discussion is going to take place today with the panel of Vishal Sharmaji and Sanjay Vasudevaji, and it will be moderated by none other than Sanjeev Singhal-ji, who was part of this development of AQMM and helped us a lot in developing this. I am very much thankful, Sanjeev-ji, for your contribution into this. And with your support, I think whenever some revision is required to be done, when we will make it mandatory, and when it will be known by everybody and something else is required to be done, I'm sure that we will do it again with your help. And this is, as you told, that this is first model in the world which any institute has developed as a model. Earlier, the AQIs are there, but as a model, it is the first one. So with this, thank you all, and special thanks to Sanjeev-ji for giving me an opportunity of being part of this wonderful webinar. Thank you very much.
Thank you very much, Durgesh Bhai. In fact, our ICAI, and we should all be proud of, has given three such models to the world: Digital Competency Maturity Model, DCMM, Audit Quality Maturity Model, and the Sustainability Reporting Maturity Model. And all three are the world's first. And you have been associated with at least two, AQMM and the Sustainability Reporting Maturity Model. And thank you for giving such a background, which now sets the stage for the panel discussion. And I know that the Center for Audit Quality, in fact, Institute is the highest regulator for the accounting profession. And there is no one who can match the capabilities of the institute in improving the audit quality as well. So thank you so much. Now, moving on to the panel, I'd like to start with Sanjay Vasudevaji. Sanjay ji, uh, what's your overall feel about this audit quality maturity model as a practitioner? What do you think? What was the need for it? Will it help members improve the audit quality, and it will instill higher confidence in the stakeholders?
Thank you very much, sir.
I will remain present in the whole session, but I'll keep my video off because this is being the first outreach program after the launching of the AQMM. So I must also listen the various things from Sanjay ji and Vishal ji. So what views comes from them. So I will remain present, but I'll keep my video off.
Most welcome, Durgesh bhai.
So thank you, Sanjeev sir, Durgesh bhai, and for giving me this opportunity, and Durgesh ji for this very erudite address, and giving comprehensively the background. And I'm very also happy to know that Vishal, I'm really privileged to be sharing screen time with Vishal, who is a great speaker, and I have great regard for him. And so thank you for that question. If you can just permit me 1 minute, and I'll just reflect on the background, and at the risk of repetition of what Durgesh bhai mentioned. See, just to set the context, I also appreciate, and this is what is happening. See, India as an economy is growing. I mean, yes, there have been hiccups, but we will definitely reach a $5 trillion size, and that is what the government is working towards. As we start, as we are moving there, the demand for professionals is going to increase, and so is the demand for auditors and quality auditors. And any growth in the economy will definitely have require more and more companies being formed, more and more companies getting listed, and you will have requirement for quality financial reporting. In the recent past, there have been some events which have not put the auditors in good light, and I think it's a right time where regulators are mentioning, they are speaking out, the society is asking questions. It is good that auditors themselves and the institute themselves is looking inwards and seeing how we can improve audit quality. Audit quality, the cornerstone of audit quality obviously is independence, quality practices, procedures, technical skills, technology. All this is dovetailed, and I understand that is the background and the backdrop in which this whole model has been developed, and the discussion is also taking place. So I'm extremely happy that the institute has taken lead on this. The one thing which I also feel, and Durgesh bhai did allude to that, but I'm a firm believer, and I've always mentioned that audit quality is not the responsibility of the auditors only. There is an entire ecosystem which needs to come together. So whether it is the management, whether it is the audit committee, whether it is regulators, I think all of us need to really speak the same language. Also understand the expectation as auditors. We need to understand the expectations of the society, the regulators, and at the same time the regulators and the society need to understand the constraints and the challenges which the auditors face in discharging their function. So I think all this ecosystem together has to develop, and perhaps this could be a starting step, but that's a conversation which we need to also have. Quality is something which is intangible. It cannot be felt. It's not easy to measure, as Durgesh bhai mentioned. There are a lot of, you can look at certain quantitative indicators, you can look at qualitative indicators. Internationally, there has been a lot of discussion and is taking place today. So in that regard, I think this is a very, very timely step. The expectation gap which we are looking at now is on really what is the role of the auditors. Is it going beyond just true and fair view? Is it also reporting on fraud? Is it actually ascertaining frauds? I don't think so, but if that is the aspect, those are aspects which one needs to look at. Are there aspects on quality which are not being considered in terms of reporting, and that is something. Secondly, are auditors communicating well? And I think if as Durgesh bhai said, that if we are able to, as auditors, you are able to follow this model or whatever model, or some way to enhance quality or to measure quality, it will go a long way in bringing out confidence in the quality of financial reporting. So with that, I think let me now address Sanjeev sir, your question, and the
Sanjay ji, please don't call me sir. I am
sir,
your
you have been
younger brother.
my you have
I'm your
been
younger
my
brother.
you have been my teacher for Indias. Whatever I learned was from you. In fact, you encouraged me also to go on and become a faculty, so I can never forget that. So please allow me that grace. Thank you very much. So just coming back to your point, your first question on the audit quality maturity model, I think I definitely support the initiative, and I think it's a great initiative, especially brought in aspects like although for some you may say that these are a given, these are some things which from an SQC standpoint or an auditing standard standpoint or an regulatory standpoint, this should be something which the audit firms should be following. And to that extent, there is a risk that we might be stating that firms are not there. So, but in any case, having said that, so I would look at it positively. I would say that even when I read through it, there was a great learning. There was a lot of things which I and my firm were able to look at it and revisit and say, okay, this is something, yes, we look at it in this manner. Yes, it could be articulated better. Can it be defined? So I think from that standpoint, yes, aspects such as practice manuals, service delivery, quality control, ethics. And the first time I think from the institute, you are mentioning about a vision statement, mission statement, very, very important for a firm to really look at, focus on technology, HR, staff retention, partner KPIs, very, very good. I know these may sound alien to some firms, but this is very, very important if it is dovetailed. So on the whole, I think very, very happy. I may have some concerns on the way, you've, given rating, but I'm sure these will improve over a period of time. There could be different aspects which we would be looking at quality. I've been focusing on audit quality, differently as we looked at, but very, very happy. So couple of concerns also, if you permit me, I can share.
Absolutely.
That, this exercise should not just become a tick box approach. It really has to come from within. It has to, again, it could start off as a capacity building measure, but it could go into a more as a guide towards looking at quality, because we need to also differentiate with the role of a regulator and the role of a facilitator. So I think once you've started this out, your next journey is going to be even more, as Durgesh bhai said, that is going to be really, really important in terms of how you, because you will, right now, what we are looking at is a baseline. We're trying to achieve a kind of a baseline, yes, with some increment, but when you really ramp up in terms of quality, I think that is where a lot of work will need to be done. So that's one thing. Again, the quality indicators should not be mechanical. There are qualitative aspects as well as quantitative aspects. The other aspect which I'm a little worried about is that we cannot, I mean, this is my view again, please pardon me if we are talking about a maturity model, then you have to allow the firms to mature. Once you tell them, okay, this is some kind of a self-evaluation, things take time. You need to invest in people, you need to invest in technology. There are no immediate results, and you'll have to work with firms, you'll have to convince them, cajole them, encourage them, and also train them. So there has to be that space given for firms to train, retrain, unlearn, learn to reach that space. So I think that definitely is something which I would strongly recommend, that please don't make it 1 year here, then again. So bring it up, get feedback from firms, modify it, allow firms to grow, give them the space to invest, as bring them up to a certain level, and give them time and also confidence to be there. So I think that's the other thing. And third, as I mentioned about the ecosystem, I think institute can play a great role in better communication from a quality standpoint, getting dialogue between regulators, between other investor forums, managements, knowing what is today required. Today, institute is not the only regulator. There is NFRA, there is SEBI, there is MCA. We need to all speak the same language. We all need to exchange views. We all need to strengthen the auditor. It is not a time to be firing all bullets at the auditor. I think together we need to strengthen the auditor. That is the language which an institute can play a very, very major role in that, and bringing confidence in firms. Let the stringent regulations, let the expectations of regulators bring in the best, not the worst amongst us. I think that is what I would like to just state to your comments. I hope I have not exceeded my brief, or I have not transgressed any line. Thank you very much.
Sanjay, you will never exceed your brief. I know you. And see, actually, before I come to Vishal, let me tell you that the very fact that it is recommendatory, the very fact that it is not to be displayed in public, so institute is giving time for firms to move up in the ladder. And also, if you look at, there are so many places where we have said that if you are having the ICAI digital tool, ICAI library, which we are committed to provide, we issued RFP for 4 digital audit tools: audit documentation tool, data analytical tool, practice management software, and digital library. And the Honorable President has given me this task of coming out with these 4 tools, which will be provided to all our firms in practice, which will bridge the gap of the technology and quality of the various levels of firms. So certainly institute is handholding. And once you adopt those tools, a firm will certainly move up in the ladder. As far as the subsequent versions are concerned, Durgesh Bhai has made it clear that this is just the beginning. You may see 2.0, 3.0, 4.0. It's a journey and it will go on. So thank you so much, Sanjay ji, for the response to this question. Moving on to you, Vishal, since Sanjay ji has elaborated this so well, on to the AQMM. First of all, your comments on the AQMM, the overall comments, and also, do you know any such parallel in the world? I mean, since you have worked with so many countries, at least you have interacted with them, and you have been a methodology champion. So what's your view on this audit quality maturity model, and do you have any comparatives across the world?
So I think so. Thanks, Sanjeev. Thanks for giving this opportunity, and thanks, Sanjay ji, for acknowledging. We have. So it's been a while we have met, and Durgesh bhai also. Nice to hear from you. So my view, Sanjeev, on this is it's a very excellent initiative, which has taken by the institute, and I'll be very honest, and you. When I look back into the regulators, because I have worked very closely, on maybe US assignments where we comply with the US regulators requirement, or maybe French regulators requirement, and so on and so forth. But I think this is something which is a very comprehensive stuff which has come up. Okay. I think so a lot of things have already been spoken. So I'll just give, what is the add-on which I just want to talk about is that what I see very different in this is that one of the criteria is measuring on human resources. Okay, so when I see, and I was it was actually, it's like everything is relevant, but I see 40% of the weightage has been given to human resources, onto the people. Now, when I talk about, it was being said that audit quality is not defined anywhere. I agree, audit quality is not defined, but how does audit quality comes up? Okay. who brings in the audit quality? Is the people of the firm, people in the profession who become, bring in the audit quality. And when we see this particular model, it talks about resource planning, it talks about training, it also talks about retention of people, which is also very, very relevant. So to maintain the continuity, develop the skill sets, sustainability, and also the performance evaluation. I think so. This all taken together, and with the people being the backbone of our profession, I think so. This is definitely going to help in at least the firms who have not been fully complying on the people matters, to work on the people matters, and which is also going to eventually develop the audit quality. So I think so that is very, very relevant. My again, the observation which I have, Sanjeev, on this is that it appears to be a self introspection by the firms. Okay, it's very good, but how do we set up a mechanism whereby independent evaluation can be done? Okay, it will be done by as a part of the maybe the peer review or something like that, but this is not going to happen for each and every firm. So how does the regulator support? Here I'm talking about the regulator is the institute. How does the regulator supports the firms who are not going for a peer review, but still they want to be evaluated? And secondly, uh, what would be the advantage to a firm from, say, for example, moving from level 1 to level 2 or level 2 to level 3? How does it comes out? I think that is something is we just need to think about. And whenever we talk about the version 2 or version 3, or maybe bring in some more guidance or clarification for the wider population, I think so. That is what my comment would be on that.
Yeah, sure, Vishal. Thanks. And I can tell you that Durgesh Bhai and the team are working on the guidance note on this AQMM, and that's ready. Actually, that guidance is ready. As far as the advantages are concerned, one is the self introspection, which you said, and I'm sure that over a period of time, regulators will be keenly looking at the maturity of the audit firms. Peer-reviewed firms, the response to that will be, since initially it's going to be mandatory for the listed entities, and all the firms who are doing audits of listed entity, they need to be peer-reviewed. So as of now, we are actually saying that all the firms which will be required to apply this AQMM, since these will be peer-reviewed, and that kind of an evaluation is possible. And the issue will arise when we extend it to every firm, whether or not they are being peer reviewed. So thank you so much. Vishal, let me take up the next question also to you. What is the role of technology in improving the audit quality?
Okay, now I think so. And you know me, Sanjeev, we never thought about doing audit without a technology. Like technology is the backbone for every like company. Still, again, even if we talk about today mid-size companies, a lot of these companies have already started migrating on some of the ERPs. And the moment you say it's an ERP, it's going to be a complex ERP. So I think so technology is going to be very, very relevant for us as an auditors. So now I think so what I see is that the technology actually makes it possible for the auditors to analyze the larger or the wider amount of the data of the companies. It's both the financial and the non-financial data. And practically what happens is that the auditors are able to like test almost 100% of the transaction with a click of a button. Okay, because it just throws you exceptional sampling, whereby it's not only that you get more comfort, but also you can give some value proposition to your clients, and there are numerous instances. I'm not going to go into those instances, but I think so that is point number one. And I think so the other thing is that now today what is also happening is that some of these sophisticated tools, which are like the data analytical tools or some other audit tools which are available, including there are something which tools available from the institute. They actually enable the auditors to perform advanced analytics, okay, which can be like some sort of a specific analytics on a particular industry, or maybe in general, and also they help the auditors understand, what the data is actually talking about. Because when we as an auditors use data analytics, we actually say that the data speaks about the books of account of the company, and including what the controls the company has built in as a part of their accounting system. So I think so, relying more and more on technology. Okay, I still come from old school as well, where we used to audit without technology. But I think so, uh, you know involving lot and more of technology into the audit is definitely improving the overall audit quality, and it's like mitigating the risk. And The future is, it's all data driven audit. Sanjeev, let me just put it this way. So if you need to work on the audit quality, more and more complexity coming in, you talk about SAP is coming up with new and new versions of its ERPs. Many companies have different versions. So if you need to keep a pace, you need to work with the technology. Otherwise, you will be left behind a lot in terms of your audits.
Yeah. Thanks, Vishal. And if I can recognize correctly, probably it is the CA brooch that you are wearing. And if am I right, Vishal? On
Sorry?
your coat, does this? Okay, fine. Moving on to you, Sanjay ji. See the kind of firm that you are leading into. What are the 2-3 practical suggestions based on your experience that you would like to offer to small and mid-sized firms who want to move up on the ladder of the audit quality maturity?
So thank you very much for that question, sir. Firstly, I think, and I may, I think this is something which firms need to really, really appreciate and understand, is that there has to be an aspiration. So there has to be an aspiration to grow and to reach a certain level of quality. I think that's something which is fundamental to moving up, the ladder. Second is that your fee. If you're only focused on fee, that is not the primary. That may not happen. So you've got to have an investment horizon. You've got to look at the time which you spend on your improving quality or other indicators, whatever you do, whether it's technology, people, process, everything, as an investment for the future. So I think these are aspects. Thirdly, you need to also set up the right team who are as passionate as you are about quality, and they have to be the ones who will have to lead this change, if I may so call. I mean, pardon me. I mean, I'm not saying that everybody will have to change, but for firms who want to really aspire to change, to be able to build better processes, I think these are the 3 things which, to my mind, would be very, very relevant. But happy to know if there are anything else. I mean, there will be a lot of other things, but I think the aspiration for growth, the ability or the decision commitment to put fee towards the later part, and thirdly, the ability to invest in people, technology, and process. I think that is important from my side.
People, technology, and process. So that's the message from your side. I'm really happy because it's a basically a catch-22 situation. There are firms who feel that first they should move up to the ladder in terms of scale, and after that they will do it. But most of the time they will find, since people, process, and technology is not there, that's why they can't move up to the scale. So I agree that the investment has to be made first, and investment is not always the investment in terms of money. The biggest investment which the professional can make is in terms of their time. Quality time is the biggest investments, because for professional, time is money.
Absolutely.
So thank you, Sanjay ji. Vishal, what are some of the practical challenges that can come up in applying this audit quality maturity model? And do you Can you offer some solutions?
Yeah, so I think so. The first one was being talked about is maybe the first and foremost would be setting up an IT or an infrastructure and the required sort of investments. Again, it's going to be a cost benefit sort of an analysis. A cost include both time as well, like not only setting up something tangible. Okay, so I think so. So that would be the first one, and my suggestion would be the firms should try to leverage as much as possible the resources which are available from the institute itself. Whether maybe it's like training or some other models or whatever. I think so that is the foremost, because these are the most common ones and tried and tested by the regulator itself, which can be used. Um, the second challenge, I think so, it would be in terms of training of employees and the timing of the training as well, because it might be felt that investing time or maybe more time on trainings may hamper the service delivery or the timing of the service delivery by the professionals. I think so. Again, here, my suggestion would be the firms can again leverage back on a lot of training programs done by the institute, maybe virtual, physical, whatever, and also look forward as to how they can increase the participation through the study circles, maybe which can be the smaller ones, so that they can actually demonstrate that the adequate training has been done. So and the third would be I think so the documentation constraints. Again, um, having said that, you have maybe 60-70 questions in this AQMM. How do you document what you have done, and how do you store them? I think so that is also one of the practical challenges which the firms could be facing into. So thereby, do you want to make use of the cloud servers, or you want to make use of some other infrastructure? I think so that is fair. So again, infrastructure is one, training of people is another one, and documentation constraints as to how do you do that.
Yeah. So thanks, Vishal. Moving on to Sanjay ji. Sanjay ji, three things which you said: people, process, and technology. And what Vishal highlighted is training and the infrastructure, the technology infrastructure, etc. I'm very happy to share that as far as the training is concerned, all the webinars are practically free of cost that are being offered by ICAI. And last year we conducted more than 5,000 webinars. There is hardly any topic which has not been covered, and it all comes free. Of course, a firm can have their own programs. On the technology, as I said, there is every possible endeavor from the institute side to offer these digital audit tools. On this digital audit tool, do you think for a firm like your firm and so many other firms with whom you have worked with, that these will help the members of ICAI, one, in improving audit quality, and second, in terms of overcoming the constraint of investment, and third, also the documentation, because I mentioned 4 audit tools: audit documentation tool, data analytical tool, practice management software, and digital library of having the tax cases, of the GST cases, etc. So do you think that practically with the help of these, institute will be taking care of the key constraints which our firms face?
Thank you once again for this question. And there was a book many years back, I think, was it Milton Friedman? I'm just trying to recall the author, which said the world is flat. And I think technology, I'm reminded of that to say that technology is a great leveler. So what you really mentioned is, you are going to, once you equip the firms with these technology tools, there is going to be greater confidence and greater quality, definitely. And there is going to be a level playing field between the larger and the not so larger firms. I I always say that. So there are firms who are aspiring to grow. So to that extent, definitely technology, and especially on the, you mentioned about data analytic. We use data analytic tools. We started increasing the use of that, where there's multiple data, and if the institute is able to provide that, definitely I'm sure firms would definitely benefit, because one, it allows you to focus, as Vishal also mentioned, large amounts of data. You're able to analyze trends. You are also able to provide value, and you are able to limit your risk. What is audit today? Audit is reducing your risk to the lowest minimum. So if you're able to do that, I think definitely. Then on documentation, one of the bigger challenges of the firms, the not so larger firms, is documentation. Ensuring documentation is done concurrently. So that definitely will be taken care of. Practice management, again, ensuring that you're spending the right kind of time on an engagement. Your utilization of resources is proper. Your allocation is done. How your billing is done, your collection, everything. So I think that's really wonderful. And if you can add to some that artificial intelligence also, when I was part of the digital auditing assurance board, we did a lot of research on artificial intelligence. And there are some, in fact, I was told recently there's a firm, when the during the lockdown, they had to carry out audit remotely. They had a software which was able to analyze PDF documents and ensure their genuinity. So these are things which you can, and they were obviously you're aware about drones doing physical verification and all. You're aware about robots doing return preparation and all. So as firms, if more and more tools are available, the only caveat which I'd like to add is that you need to also be sure that as a regulator, if you are providing these tools, you should not be assuming any responsibility for the quality of the firm. So I think that, I'm sure as an institute you'll be able to. But to answer your question, a definite and emphatic yes. But along with that, please, not only providing but training people, ensuring
Absolutely.
that the other thing also, sir, is or ensuring that the results of these tools are properly understood. Because one of the common mistakes which auditors make is not taking the results of data analytic tools in the right manner. So I think that is very, very important, because, and I am aware that IAASB is doing a lot of work on the data analytic tools. In fact, I was part of that group in terms of really looking at the findings of the data analytic tools and how they can be properly reported from an auditing perspective. So again, to sum it up, very, very happy with this initiative.
Yeah, thank you, Sanjay ji. But there is another school of thought who says that it's not actually ICAI's responsibility to provide audit tools, and ICAI should not be working towards this direction. And second, if ICAI will give the tools, who will apply? Which to my mind says that as an institute we can provide training, as an institute we can provide tools, but obviously as an institute we can't force people to apply. So any different thoughts on your side?
So I've already given the caveat, sir. I have mentioned to you that you need to look at it. I particularly, whosoever provides the tools, you have to, people have to. If you are encouraging, I think that is good. If you can say you are encouraging, would be better. If you are making it, making wide publicity, I'm sure there is a lot of work which has been done. I was told when I was part of the council by the French Institute in developing some data analytic tools. So perhaps that experience, or maybe the UK Institute, the England and Wales would come in handy. So those are my thoughts.
Absolutely, I can tell you that as a part of the RFP, we have mentioned that 40-hour training module will also be made by the service provider, covering the various aspects.
So as long as you ensure that it does not impinge on your regulatory function, and you are in no way let's say, certifying the quality of people who are doing it or the tool, I think it should be okay.
Absolutely. Right.
And can I just add here, Sanjeev? I think
absolutely,
so.
Vishal.
One of the very
Yeah.
relevant points which Sanjay ji has mentioned, I think so, because and that the tool is something which is designed by the technicians. Okay, uh, everything what the tool gives will also depend upon what has been fed into the tool. Okay, so the input, the risk of the input, still has to be taken care of by the auditors. I think so. That is extremely important
Exactly.
for that, because nobody is going to certify that. That the moment you pick up a tool, it is always going to give you the right result. I think so. That is a bit word of caution for every professional to keep at the back, at the back of the mind, that the more data, the more chances that the input might have some errors or issues. I think so. That has to be taken care of.
Sure. Absolutely, Vishal. Vishal, one question for you, and this may be the last question for the day, and then maybe any closing remarks. So there is a question from CA Narayanan from Mumbai, and this for you. What's the link between the SQC1, the audit firms have to follow presently, and the AQMM? And does the AQMM go beyond the SQC1? Would ISQM1 be implemented in India? So this second part probably I can answer. But your view on whether AQMM will go beyond the SQC1?
I think so. Again, SQC1 is the core, quality control standard, which is global benchmark. I think so. That is definitely a global benchmark which all the firms has to take care of and look into that and maybe responding on all the 6 components of the SQC1 which has to be there. I think so. Audit quality maturity model, I would say, is a much wider aspect, because it captures not only about the operations of a particular company, or maybe when I say operations is like the practice management operations or the functional attributes. It also captures the human resources, wherein it also talks about briefly a component of SQC1 as well, that how the firm is addressing the requirements of SQC1, and there is a scoring for that. So I don't think so that AQMM will in any which case is going to supersede or be say a maybe a alternative to SQC1. I think so that is very clear.
Yeah. Thanks, Vishal. On the ISQM1, I would like to say is the institute will take a call by when it is to be implemented. The auditing standard board, AASB, is working on it. Sanjay ji, any closing remarks?
No, thank you very much. I think from the question which just came up in terms of the SQC versus the AQMM, I think very, very interesting question. And I think Vishal, you answered it very well. Just wanted to add that SQC is a compliance requirement. AQM is a more an aspirational requirement. It's an evaluation. And I think that is the fundamental difference which we need to understand. Anything and everything which is done there is for the firm to really evaluate and to work on that. And it's a very comprehensive aspect. And I did mention that there are certain aspects which perhaps personally I may not agree coming there, but yes, it's a much broader concept. My only what I'd also like to add is I think this is a great initiative. It's a great start. Let's nurture it very well and work with the firms to actually draw up a roadmap. I think Durgesh Bhai did talk about a roadmap. Let that roadmap be very clear from the institute side also, and what you are presenting to the firms also. I know Vishalji also mentioned that what happens if you move from level 1 to level 2. I think those are questions which we should be able to articulate very well. We should make firms very comfortable with. we should help firms to become aspirational. And if that we are able to achieve, then I'm sure this will work very well. And I'm sure there will be other aspects of quality which will come in, which also should be considered and which should be dovetailed. So these are my as you may say, thoughts. Obviously the last word will rest with you, sir. Thank you.
Thank you, Sanjay ji. Vishal, any closing comments from your side?
I think so. Overall, I'm very happy with whatever initiative has been taken. I think so. Maybe one thing I would just like to add to, like, what is the main thing which is missing in it. Specifically, if we talk about mid-sized firm or a smaller firms, okay. So where does a practitioner go and consult in case of a doubt, okay? How can we bring in a concept of a consultation, and how the regulator can or the institute can maybe set up some mechanism for a quick turnaround for consultations? I think so. That is because the concept of a consultation is actually mitigating the risk and widespreading a professional maybe judgment which has been taken by the other practitioners. I think so. That is something which if we can just bring in or talk about that as well in the later versions to come, I think so that is going to be a more increased networking between the practitioners and further mitigating the risk.
Thank you, Vishal. Since we have the benefit of Durgesh Bhai being there, so Durgesh Bhai, any closing comment from your side?
No, very good deliberations. What are required to be done also have come from both the learned panelists. And I would ask and I would request them, if you have something in your mind, what kind of things should be added in the roadmap to be developed for the purpose of implementation of the AQMM and guiding all the Indian audit firms. I think it will be our pleasure to have the ideas from you. Please feel free to write us how it should be proceeded, because since it is being the first in the world, we are also in the research mode only, and your knowledge and expertise on this will help us to develop it in a more better way. What I feel is so. Please feel free, do write us, and we are open to it, and we will see that best can be given to the Indian firm so they lead globally, which is the vision of our Prime Minister also and of the Institute also, which we have put in our document of 2030, ICAI 2030 vision document. So in that it is there that the Indian firm should be the leading global chartered accountant firm. So this could only be happen when the guidance from the stalwarts like you comes, and we add those things into the roadmap, and we help the Indian firms to grow. For this, thank you, Sanjeev Bhai. Thank you.
Thank you so much, Durgesh Bhai. I must say that you have a very large heart, accepting, and we all accept that since this is the world's first such model, so we would certainly agree that there will always be scope for improvement, and scope for improvement will be there even if it is 10th version, and accepting with such a humility that if there are any suggestion, in fact we have issued the exposure draft also. We received a number of comments, and we have incorporated a very large number of comments into it, and these comments were deliberated in the meeting of the Center for Audit Quality. And as Durgesh Bhai said, Institute is always open to suggestion. It is your institute. It is all those, there have been 3,700 plus hits for this program. So all the members who are viewing it live, we would strongly encourage all of you to give a suggestion. This is the first such program. In the coming days, you will see more and more programs on the audit quality maturity model. It will be difficult to attract audience for this kind of a program, but I'm sure when we have speakers like Sanjay ji, Vishal, they will act as a brand ambassador for this program and for this model, and things will certainly go a long way from here. And I would also like to add that recently the Committee for Member in Practice has issued a portfolio of the discount schemes and the welfare schemes, which the institute has taken for all the members. There are about 28 schemes, and this has been very, very widely circulated on the WhatsApp also. So please make best use of all this, what is available, and do let us know that if you feel that at the institute level, we should do more. From our side, we continuously endeavor to do more and more, but we'll be happy to have your suggestion. And on 15th, we are doing a very interesting program. This next webinar, success stories of some of the CA firms. And our honorable past president, CA Ved Jain ji, would also be there. So kindly join in for that program as well. And then we are coming up with a very large number of programs, 4 programs, where on 17th, 20th, 26th, and 30th, where the president, vice president, and all the council members from the northern region would also be present with various branches in the northern region. So thank you very much. It was really a great session for me. I enjoyed the I'll say the mentorship of Ashok Batra ji and the companionship of Sanjay Vasudeva ji, Vishal Sharma ji, and Durgesh Bhai. Thank you very much. And with this, we come to
Thank you.
close.
Thank you.
Thank you
so much. Thank you.